Good morning and welcome to the Investors Management Group presentation for Canopy Phase 2 in Charlotte, North Carolina. We appreciate you joining us and look forward to the discussion. Today, we will present a high-level overview of the Canopy Phase 2 investment offering, including a look at the real estate asset, the business plan, ownership structure, and investment terms. We'll do our best to deliver the presentation in 25 to 30 minutes and allow for a 10 to 15 minute question and answer session at the end. For current clients on the call, you will already be familiar with IMG's value add approach that we're following here with Canopy 2. For all attendees, there's a lot of new material to cover today in terms of unique features of this property and IMG's more conservative approach to renovating and underwriting given the current economy. The hosts of today's webcast are Carlin Conklin, Principal and Co-President, and myself, Dave Mickelson, Director of Investor Relations. As housekeeping, all attendees will be in listen-only mode. To submit questions, please use the chat pane, and you can send the question to the organizer. For those not on the web, feel free to send questions to me at investor.relations@imgre.com. We will collect questions during the presentation, and then Carlin and I will address those during the question and answer segment at the end of the call. With that introduction, I'll jump right into talking about the Canopy 2 offering. So today's discussion is about the second phase of Canopy at Baybrook Apartments, and we're referring to this offering variously as Canopy Phase 2 or just Canopy 2. As context and background, Canopy Phase 1 was the ownership period from February 2019 that will continue through mid-November. Phase 2 is the ownership period that will begin in mid-November and go forward. So the investment offered here is a recapitalization between Phase 1 and Phase 2, which we'll explain the mechanics of in the call today. So just pausing here on this slide as an introduction to the property, you can see it's a large apartment complex at 324 units. It's low density, spread across 30 acres with quite a bit of large trees and landscaping. At the very top left corner of the photo, you can see the single family homes. This is the neighborhood that surrounds us, and that neighborhood contains homes valued in the $500,000 range and above. We'll talk about the demographics, why we like the neighborhood, and why we think that it's an upscale, desirable location to be invested in here south of downtown Charlotte. So we'll dive into these points in more detail later, but now I'd like to pass the discussion to Carlin to open up about our sponsor overview. Carlin, I don't think we can hear you. You might be on mute.
Thanks, Dave. I was doing a heck of an introduction there too. Good morning. I know. Good morning, all of you. Thank you for joining us this morning. We are very excited to present to you Canopy Phase 2, as Dave has said just a moment ago. Most of you on this call are current clients, or you are considering investing with IMG for the first time. Our staff is very, very deep in experience in the multifamily arena. Our goal and our mission is to preserve and grow our clients' wealth. And our vehicle for doing so is multifamily properties. Our focus is on wealth preservation. It is on portfolio diversification as well. And we have, for us, our track record on 22 full cycle investments has been IRRs greater than 25%. And on the 4 sales this year, we have projected an average IRR of 22%. Dave is going to share with you a couple of case studies also that more clearly articulates our recapitalization from a Phase 1 to a Phase 2 property.
All right, thanks, Carlin. And so like Carlin introduced, that we'll talk about the specifics of the Canopy 2 recapitalization. And I thought it would be helpful to briefly summarize our most recent recapitalization for context. So first, let's start with a quick definition of what a recapitalization is. And simply put, it means trading out the debt and equity between ownership group 1 and ownership group 2 in the same property. So this case study for Clearwater Oaks, located in Tampa, I think serves as a great illustration. In 2017, IMG had been partnered with its first equity partner for about 2 or 3 years, and we facilitated the recapitalization of Clearwater Oaks to accommodate for the objectives of this first ownership group and the second ownership group. The original partner, owner number 1, wanted to exit due to reaching kind of the timing of its funds and achieving its return targets. IMG, as the partner, saw additional value in holding the property and wanted to stay in the Tampa market and continue with the capital projects that had been in progress. So through the recapitalization, we brought in an ownership group 2, and that included a group of 10 new investors. The results, by 2019, 75% of the units had been renovated. We'd installed energy saving features, new community upgrades, such as a new fitness center, dog park, and laundry facility had been added. We were earning rent premiums from the renovations. And with the attention to management and the positive market trends, over that entire ownership span between groups 1 and 2, we'd grown our NOI 31% annually from 2014 to 2018. So with group 2, eventually we sold in 2019, and for both groups, it was a home run. There could be a variety of reasons for recapitalization. I think for our example here with Clearwater and in our Canopy offering, the reason is basically that owners in group 1 achieve their goals and owners in group 2 identify good investment value to continue the hold cycle. So with that as kind of background, we'll talk about Canopy 2, the similarities and some of the differences. So here with Canopy Phase 1, as background, we acquired Canopy in February 2019. Over the last 3 years, the Phase 1 ownership group repositioned property management, invested almost $3 million in value add improvements, and those were dollars spent on the amenities sets and the unit interiors. And of course, over the last 3 years, capitalized on a really strong rental market. And we saw that both in the way that the property appreciated and in the way that the market rents had a natural or an organic lift to them. At this point, Phase 1 owners have already achieved an appreciation of about 50% on their equity. And that's the point where our investors and IMG typically look to either exchange or refinance. That gives investors an opportunity to re-leverage that equity and start earning a higher cash flow based on that new higher leveraged amount. So this level of appreciation that we've achieved today was originally projected to occur between years 4 and 5, which would be right at the end of our kind of originally targeted or estimated hold period. Here we've achieved it in less than 3 years, and because of this, owners have voted to sell and, like I said, re-leverage into another IMG offering. So we consider Phase 1 a huge success for our investors there. We do see additional upside in holding the property. There are improvements that we can continue to make. We can continue to drive rent premiums, and we see future in the strong Charlotte market as that continues to rise. So arriving at a fair transaction price was a key piece to making the recapitalization work. It had to be fair for both groups and attractive for both groups. So here the price that we're using was set by the appraiser. The appraised value was determined by an independent appraiser from CB Richard Ellis, who was engaged by the lender, and this fair market price benefits both groups. Additionally, there are some kind of unique advantages that go both to the Phase 1 owners and the Phase 2 owners. For example, with Phase 1, completing a 1031 exchange was at the top of their priorities. And so with the controlled sale timing, we were able to do that here. Also, we can save on brokerage fees without having to use a broker between the two ownership groups. So that's a benefit to phase one. On the phase two side, we benefit by acquiring an asset with a great performance track record. We've seen that since 2019. We tested it, or the market tested it, definitely during the pandemic, and the property proved to be a strong performer there. There's a lot of strength just in the sheer fact of maintaining the continuity with the existing management company. That should keep operations stable. And then the third point is that we can continue and keep up the momentum that we've started in phase one with the renovations. We've got the scope of work done, we know the finishes, and we've got the vendors in place. So those are some of the benefits. I think the really unique advantages to using a recapitalization structure and having all parties win. I'll turn it back to Carlin, and she can give an investment offering overview with some of the front terms.
Thank you, Dave. So the Canopy 2 offering falls in line with the metrics for the other offerings that we have done this year. We are raising $31.2 million. The debt is lined up now with Freddie Mac at $38.5 million. Our capital budget is $4 million. So, and then with all of our tenant in common structures, there is no promote. And we have listed here the fees, which are typical fees, IMG fees for the oversight of this asset and the acquisition of it. So a 1% acquisition fee, a 0.3% financing fee. We are charging an asset management fee during the hold at 2 points and a construction management fee at 7 points. We also now charge an insurance administration fee for every property at $1,500 annually. And that is also for risk management associated with claims. And our disposition is at a 1.25. And finally, an incentive fee, which is based on performance above projections. So the minimum investment is $25,000, and funds will be due on the 5th of November, and our anticipated close date now is November 16th. In phase one, thank you. In phase one, we completed nearly $3 million in improvements. And you can see with the pictures here from the clubhouse, at one point there were 3 pools. One was an interior pool. We now have 2 exterior pools. And the interior, where the one pool was at, is now a state-of-the-art, gorgeous exercise facility. So from dog washing stations to lockers for packages, the amenity sets are modern, they're beautiful, and we have also done some of the interiors for the units themselves. As for phase two, what you will be bringing as phase two investors is primarily updating the exterior of the building so that people get out of their cars. So what happens now is we have this incredible updated property, but it's on the inside. With the exterior, the siding itself is at its useful life, and the exterior of the building will require about $3 million to recite it, to improve the landscaping, to really modernize this property. The goal is to have someone drive to the property and get a wow factor on the exterior. Then they walk in and they already have a wow factor on the interior, particularly with the clubhouse and the amenities sets. So with $3 million would be the exteriors. As for the interiors, we do have about $1 million dedicated to the interiors. We have some classic units remaining that were not completed in phase one. Of those, we will be doing some cabinetry, updating appliances, adding washers and dryers, and again, investing so that we can get the price premiums that we are looking for in our newly renovated interiors, that we can get the rents that we are projecting. So Dave, I'm going to turn it over to you with the ownership structure.
Okay, very good. You get the nice, pretty photos, and I get the ownership structure slide.
I know it works for me, Dave.
It works. Well, this is good. The tenancy in common or TIC ownership structure is what IMG uses to make its real estate investments. I think to clients who have partnered with us before, this is very familiar, and this is what we almost always use in our investments. But I think it's always great to repeat for people who are new or just as a reminder. It's been a structure that we've gone to because it works well to deliver transparency. It allows owners to participate at different levels, and it accommodates investors with different equity amounts or investment goals. As an example, as a tenancy in common, we're usually putting in 10 different tenant in common owners into the ownership or the equity piece. Owner number one is an owner that welcomes all the limited partner investors, and those can be investment amounts from $25,000 up to several $1 million. Typically, in our TIC owner one, that's an ownership group of about 50% of the equity right there. In terms of investment vehicles, it accommodates IRAs, trusts, individuals, spouses, LLCs, just about anything that you can think of. And those are very easy investments. You receive a K1 statement at the end of the year, just like your typical partnership investment. And a unique thing about what we do is when this property sells at some point, we'd expect to line up an exchange option for these partners. That's rare for a limited partner to be able to exchange, but we've been successful in doing that, and that's been, I think, a great appeal for this structure. The other co-owners, generally TICs number 2 through 10, those are more independent. Those are owners who are a lot of times completing a 1031 exchange. And this TIC structure allows that because what they're purchasing here is a like-kind real estate investment. So these investors become owners of an undivided interest in real estate. Those minimum investments typically start at about $750,000, and they go up from there. For Canopy, which we're presenting today, these TIC positions 2 through 10 have all been taken, and what we're presenting here are investments as limited partners in the TIC owner number one. To all the investors, whether they're a TIC investor or a limited partner investor, the returns are the same, the tax benefits are the same. Everybody receives returns based on their pro rata ownership in the entire property. So that part doesn't matter as much. I guess the one benefit to the TIC co-owners 2 through 10 is that 1031 exchange piece where they can use an exchange to come into ownership in the property. On the other side of the capital stack is our loan. The leverage here is about 60%. We're using a loan product that we always use. Again, it's a Freddie Mac loan, variable rate, really attractive interest rate pricing right now. The spread is 250 basis points over an index of about 5 basis points. So if we close today, our all-in interest rate would be about 2.5%. And kind of the first question that most people have about a variable rate loan is, what about the uncertainty? What if rates rise and that interest rate goes up unexpectedly? That we mitigate for by purchasing an interest rate cap. That interest rate cap will be about 5% for this deal. And what we always do is stress or underwrite this alternative scenario. What if that interest rate went up to 5% to that capped amount? How does the property cash flow and how do we operate? And so we're sure that we'd be sure to underwrite in a way where with that capped amount, there is cash flow, we're paying debt service, there's some cash flow to investors. It's now what we're expecting, and it's now what the markets are projecting for interest rates going forward. But that's kind of the mitigation and that risk piece that we've hedged against in the future. So with that, we'll continue moving into our investment updates. This is kind of a healthy snapshot for where we are, and it helps us kind of set our course going forward. We have already raised about 95% of the equity to date. This offering came out 2 weeks ago on September 29th. We've received a positive response so far. Our standard offering process is what we followed here, and I think this is a good educational point too. The first thing we do is release the offering memo, first to clients and then to all prospects. Then we begin to receive emailed commitments and calls for reservations for various TIC pieces or limited partner pieces. Then we release the full due diligence package and invitations to e-sign subscription documents, which will formalize the investment. So after this webcast today, we'll begin to send out those e-sign subscription invitations and then get those signed in the next week or so, with funding due around November 5th. With the remaining $1.6 million, that's equity available to you as investors and limited partners coming in. We're also planning to partner with a $3 million equity piece to our marketing partner, CrowdStreet. CrowdStreet is a crowdfunding firm that's provided good exposure to our platform in the past, and they typically, we work with them on about a third of our deals. We're on track for the same this year. Canopy 2 will be our second deal with them out of 7 deals that we've done this year. IMG itself is participating as an investor in the deal with about $3 million of its money. That's about 10% of the total equity. And I talked earlier about the TIC structure accommodating 1031 exchange buyers. That's the case here. Those TIC positions are gone, and all 9 of those TIC positions went to buyers completing 1031 exchanges. Next, we'll talk for a moment about the financial summary. This is a very summarized version, and you've got the full financial model available to you in the offering memorandum, so you can see the assumptions and you can see the detail. But I think this is illustrative and helpful just to kind of touch on the main points here. This is a conventional sources and uses, and I guess a really familiar ratio for us. The debt is about 60% loan to purchase price. We're raising about just over $30 million here for the equity. On the capital improvements, Carlin talked through how that will be applied to the exteriors and the interiors. That is about $12,000 per unit that we're investing. You can see in the projections, we've, I think, underwritten very fairly and conservatively. If you look at the actual trailing 12 months versus our first year of projected performance, that's a revenue increase of just about 2%. You can see that expenses in year 1 decrease. That's because a lot of what would typically run through your profit and loss statement as a repair and maintenance expense or a turnover expense, that doesn't show as an expense because that's something we're capitalizing and we're paying for out of the CapEx budget. So that helps us definitely in the first year and the first couple of years to keep our expenses lower. What that does is it drives a cash return to you projected at about 5.8% in year 1. As rents grow, as the market lifts, we expect those distribution or cash on cash yield rates to rise over time. And over 5 years would anticipate an average cash on cash return of about 6.2%. You can see by the end of year 5, we're projecting an IRR just under 13%. An equity multiple of 1.7%. These are numbers that are right in line with the other deals we've done this year, and I think very favorable when you consider kind of the risk-adjusted return, the fact that we've mitigated or have eliminated a lot of the risks and feel really positive about the upside in the future for the property. So with that, I'll keep the conversation going. I'll pass it back to Carlin to talk about the IPA strategy.
Thank you. So IPA is our acquisition strategy. We've written articles about it. We frame all of our acquisitions within that IPA moniker, and which stands for intrinsic value of the real estate itself. You know, the neighborhood, the market, job growth, income growth, what's intrinsic to this property where it's at. Secondly is price per pound or basis, or what are we paying relative to other properties within the market, but what are we also seeing that perhaps other buyers are not seeing that we can continue to grow the value for our investors. And finally, it's affordability. And that doesn't mean that it has some sort of government program. Affordability is where are the household incomes, where is the opportunity for income growth for our renter pool, and how is that affordable within the market. So if we spend, for example, on Canopy Phase 2, if we spend $4 million on improvements to the property, will we get a return on that investment? Will the renters be able to pay? So this is our strategy, IPA, which we will frame for you in just a few moments. And what I would also like to remind you of for the IPA, those of you that drink beer, you know what IPA is, one of the foremost of microbrews. We know it a lot here in the Northwest because we grow in the Northwest some of the best hops in the world. So we know IPAs. But this is the last week to register for our upcoming San Antonio event that's happening at the end of the month. And we sure encourage you to come. And if you do, you can also drink real IPAs with us. So Dave is going to start with the actual intrinsic value.
All right, great invitation, Carlin. So talking just briefly about intrinsic value, this is in a nutshell, where can IMG identify growth, demand, and appreciation? So number one, population growth. How does Charlotte rate for population growth? It's a metro of about 2.6 million. The metro population has expanded at about 3 times faster than the national average and forecasted to grow another 21% in the next 10 years. For us as apartment operators, this is the right kind of population growth. These are younger households who are educated, mobile, and in their renting years. A big one too is employment growth. Charlotte's recognized as a respected financial hub, a regional healthcare center, and a location with higher education options. It's become the second largest banking concentration outside of New York City, and now is home to corporate headquarters of Bank of America, Truist Financial, and the East Coast headquarters for Wells Fargo. Also for employment, the unemployment rate in the metro is about 120 basis points below the national average. It's an employment hub now and in the near term and probably in the long term because of the way it's established itself as a lower tax, business-friendly environment. We can see that in the Forbes ranking in 2020, ranking Charlotte as the #1 best state for business. So that's a huge driver and something that will continue to lead this growth economy in this area going forward. On the next slide, this last key piece of intrinsic value, appreciation. Where are real estate values headed in the greater Charlotte metro generally, and how are they being affected at a very local level? Speaking to Charlotte generally, we talked about some of the favorable economic and demographic trends. That has piqued investor interest, and last year was a record-breaking year for real estate transaction volume of more than 1.4 billion in investment sales. For us, that's a fantastic signal. It means there's demand, there's activity, there's vibrancy in the market, and those are the markets where we like to be trading in. The Charlotte apartment market has been expanding fast. It's experienced some of its largest rental housing supply deliveries in its history, but despite that, it's absorbed those units. Occupancy has stayed stable in the 95% range, and rents in Charlotte are growing this year by double digits. At a neighborhood level, we really like the Canopy at Baybrook's infill location. This whole area was generally developed in the 80s and 90s. That's good for several reasons. One is that as a market that's pretty well built out, the supply and demand balance is balanced and it's predictable. There are no new apartment construction projects underway near our property. There are only 14 units in total across the whole submarket approved for delivery in the next 2 years. Also, the age of the neighborhood has seasoned in a good way, and that is because the established single-family neighborhoods that surround our property offer very, very strong demographics. These are people who have commuting options and retail options north to downtown, south to the Ballantyne Business Park area, and then east and west along Highway 51. It's a neighborhood with some of the best schools in the metro. And that's actually one of the reasons that's mentioned by new tenants moving into the property. They're coming for the schools. They're coming for the ambiance and the quality of life here in this South Charlotte neighborhood. So I'll pass it back to Carlin to talk about P, price per pound.
Thank you, Dave. With the price per pound, we are purchasing this property for Canopy Phase 2. Phase 1, of course, is selling at the appraised value of $63.5 million, which is $196,000 per door. In the appraisal, comparables with adjusted values, they came across as about $190,000 to $200,000 a door range. We are adding to that about $4 million in our capital budget. So we will be in at $208,000 a door. And we believe very strongly that with those improvements that we are making, that we will be able to get a return on that additional investment, because we are bringing the property from a 1988 look up to a 2020 look by the time that we are done on the exterior. The appraised cap rate at pro forma is about 4.25. By our underwriting numbers, it's about 4.15. And the value as we go over time is an exit cap of about 4.8. So the pricing is market pricing here on a property, as Dave said, in a very, very good location, and with income growth, with population growth, all the intrinsics that we know will support our price. As for affordability, the A of our IPA, when we talk affordable, we are talking about, can this tenant base, can this market support the investments that we are making in this particular property? So after we've gotten through the pandemic, or mostly through the pandemic, right now the average rent, in-place rent at Canopy is $1,126 per unit across the unit set. We are projecting at the end of year one for a $1,338 rent. And that is going to be supported by growth in the market, growth in jobs, and we believe that we can raise those rents. In addition, even with the improvements that have been made so far, as the new tenants come in, they're paying anywhere from $100 to $150 in rent premium coming in the door. Also, to qualify for our end of year one rents at $1,338, a household would have to have income of about $50,000 annual income per year. And you can see from the notes here that the average incomes in this neighborhood are far higher than that $50,000. Even at the end of year 5, our rents are projected in our financial model at $1,588. So to qualify for that, a household would have to have annual income of $57,000 a year. And we believe the metrics are here in affordability to attract some of the best renters in the market, because this property will be updated and it is highly affordable. So Dave, for the investment recap, I'm going to turn it back over to you.
Very good. So we'll recap what we've presented here today in a few bullet points, and I'll invite anybody to access the full offering memorandum for the full detail, the full financial model, and kind of all the additional information that we touched on here in summary. But we see all the key pieces of a successful investment here for Canopy Phase 2. That's why we've planned to recapitalize it and have had great response. There's a continuity between Phase 1 and Phase 2, the strong track record, especially through the pandemic, good relationship and performance between IMG's asset management and the Lincoln property management teams. And we talked about purchase price at a fair market value in a location that just keeps appreciating. This neighborhood has become more desirable over time with solid demographics. Another thing we like proven demand for these renovated units, a scope of work that we know, rent premiums that we've captured and that we're targeting again here. Very little new competition. And then really the greater Charlotte market, that whole story has been fantastic and ranks as one of the best investment markets nationally. It's a market with expanding jobs, an ideal renter profile, and really business friendly with great future potential to keep drawing in migration and jobs that'll propel this housing market further. So with that, that'll conclude our webcast slide presentation, and it'll lead us into our question and answer segment of the call. As a reminder, if you'd like to submit a question, you can do that in the chat pane, or you can email at investor.relations@imgre.com. We've received several questions so far, so Carlin and I will go ahead and get into those. And this is Carlin's favorite part of the call because she never quite knows what I'm going to ask her. So it's like the hot seat. Well, Carlin,
Dave, I get the pretty pictures and to invite people to have a beer with me. So just give me the softballs.
No, this is where I get revenge. So,
okay.
So Carlin, this is a great question and it speaks to our loans. If the plan is to sell together, how will we prepay one loan and start the next loan? How does that work with these variable rate loans?
So this is a hands-off transaction. So the selling group is selling, they're paying off their loan. The buying group is coming in with a completely new set of borrowers and the debt. So it's very hands-off, it's very arm's length, and it's very, very smooth. So there's no mixing of any debt or anything like that.
Very good. Good. And then I'll add too, it's a great point. One of the real reasons why we go with these variable rate loans is because the prepay terms are so favorable, right? It's a 1-point exit fee. It doesn't depend on how rates have moved since you closed the loan. And so that's what the exiting group is doing. They're paying the 1 point here. And when phase 2 group sells in the future, they'll pay the 1 point. That's been a really good strategy for us. Okay, here's a great question. And maybe you could see that in the very first slide of the whole presentation, but there are 2 phases of the property. About half was built in '86 and half in '88, and they're on either side of Baybrook Lane. And so the question is, are there cross-use easements or agreements between the 2 sides that share amenities? Then how is that street in between maintained? So I can answer that. No, there are no cross-use easements here. That would be more common if those two phases were owned maybe by different ownership groups. But this would be the same ownership group. As far as I know, it's always been together as one ownership group. So none of those cross-use easements or use agreements come into play. And I think the layout works pretty well because there's that big swimming pool and the indoor fitness center on the east side of the property. So that becomes this kind of community hub for that side. And we've got the leasing office, another swimming pool, and kind of this community plaza on the west side. And so each side has its own kind of gathering place, but of course everybody's welcome to go to whichever side they want to. So there's been no problem there. The road between those 2 construction phases, that is a city street. So we don't pay for the maintenance there. Our lots go up to that street and we do the landscaping, and we've got signage and trees and flowers in between. So it's got a great appearance, and we maintain our piece of the land, but don't have to maintain the street. All right, Carlin, another question for you. Can you talk about when we purchased the property in 2019, we paid a price of $45.5 million, which is $140,000 a unit. Can you repeat, what are we selling it at now? And kind of what do you see for that appreciation rate for the phase 1 group?
Yes. So there has been a great appreciation in multifamily nationally. There was, because of just supply and demand, because of investor expectation of returns balanced with risk, multifamily is a highly, highly sought after investment type, and that has profoundly driven down cap rate. So there has been cap rate compression. So much of what has happened at Canopy is the fact that we have raised rents, yes, but it's also been a story of cap rate compression across the country. And that has allowed for a group such as the Canopy Phase 1 group to absolutely capitalize on what they have spent already. It allows them to exit years earlier than anticipated with returns that they are wanting. And what it allows for Group 2 to do is to buy this at market where we are today. So we've moved from 40-some million to 63 million, 63.5 million in price. That is a combination of cap rate compression, where interest rates are, with the fact that we have raised rents, and the fact is we have stabilized this property through a pandemic. So for both groups, at market and at appraised value, this is a very fair price.
Excellent. Good. And that kind of moves into another, actually a set of questions, 2 or 3 kind of around the same theme. And that asks about what is our actual cap that we're purchasing at here, and what are caps kind of doing across the market. And I'll address that one here. In our financial model that has the full analysis and the underwriting, what we do is we split up the trailing cap rates by different time periods. So one would be, what's the trailing cap rate on the 12-month, on the 3-month, and what if you annualize the trailing 1 month? How do those cap rates compare? And between those 3, the actual cap rate on those trailing figures is about 4% or 4.15, kind of depending on which one you slice. And then going forward, the appraiser, when they put a cap rate on like a capitalized value on the property, they talk about a stabilized or pro forma 4.25%. So those are market rates. Those are the cap rates we've paid across the country, generally for, properties around this age, plus or minus, slight adjustments for age or condition or location, but kind of right within that range. And so the appraised value was in line with what we'd expected. The question too about what do we see happening with interest rates and cap rates in the future? Boy, I guess everybody would have their own opinion, and I'm happy to offer mine, but you'll probably get 100 opinions for 100 people you talk to. We know that cap rates follow interest rates up and down. We also know that interest rates today are about as low as anybody could imagine them going, right? Like we talked about, the loan that we're putting in place here for the Canopy 2 acquisition, the index is 5 basis points, and then our spread is 250 basis points above that. And so it's hard to see the index going negative. So I don't think interest rates can fall any further. And what that would make me think is cap rates probably wouldn't come down too much further. We've seen them come down a little bit over the last year just because there's been so much demand for multifamily, like Carlin mentioned. But I think forward expectations and the reason why people are buying at these cap rates on apartments today, they see, number one, a great housing supply imbalance for multifamily that favors the landlord, and it gives us pricing leverage for rents. We're seeing that play out starting, even in Q1 this year, and then really kind of ramping up in Q2 and Q3. Across the country, we're getting renewing existing tenants with rent premiums between 4 and 6 or 8%, and putting new tenants in or lease trade out up between 7 and 10 or low double digits, 10%. The CoStar report for this market is projecting rent growth of 17% year over year. That's really high, and that's not something that we've seen, but the appraisal also points to some really favorable rent growth going forward. So taken all together, I think that's one of the motivations. People are willing to pay a lower cap rate today because they see huge upside and some really great performance and room to run going forward. Well, Carlin, I'm going to kick one back to you. because you took all the pretty pictures. Here's a question about some of the pictures. The question is, some of the roofs look a little distressed in the pictures. What do we know about the roofs?
Thanks, Dave. The roofs are relatively new. They were all put in the last 5 to 10 years. And so they will not only withstand our ownership, which are underneath our 5-year projections, but in the event we do sell in 5 years, there will be remaining useful life to the new buyer that comes in. We acknowledge they don't look good in these aerials. And so we do have in our budget, as we do the rest of the exterior, we will be doing, absolutely do roof cleaning to brighten them up. But the roofs are not on our capital budget at all.
Very good. Okay, well, good. I'm going to take 2 more questions, and we're also right here at the 45-minute mark, and we were shooting to be done at about 45 minutes. So I think it's lining up perfectly. But here's a question. Did we consider phase 2 group assuming the phase 1 loan and saving fees? That's a great question. We wouldn't have saved too much in fees. It's a 1-point assumption to assume this kind of loan, and it's not much more than that to put a new loan on. So that's one consideration. It wasn't a huge, I guess, expense saver. And then number 2, and the bigger consideration is, we'd be assuming a loan that's low leverage, and that's not too desirable. So when we run our kind of return scenarios and forecast how those returns to investors look with different sized loans and loans at different pricing, the bigger loan with the higher leverage with today's rate was clearly favorable. And so that was the decision to put a brand new loan on it, and that's what we're doing here.
But also, Dave, I'm going to go ahead and add to that real quickly. We are not an investment group that puts on amortizing loans, because the important thing is cash flow and what is the overall return that you're going to get on your investment. And so consequently, with the current loan that is almost 3 years, it's going to start amortizing in 2. So it's far better off for all of our investors to start with a new loan that we have 5 years of interest-only payment.
Yeah, fantastic catch. Huge point. Good point to make. And you'll see that in the financial model too. It's a 5-year projected hold period, and through those first 5 years, no principal payments, which helps our yield to investors. Very good. And last question. Great upside in the rents from the phase 1 experience. Is there any other market data that supports steady increases in rents? Well, yeah, fantastic question. Something that we hope to be experts in. We're owners. We've been owners there in that market for more than a decade. We've had great track record with Canopy. What we've underwritten for rents going forward on our rehabs actually lines up with what we're getting now on rehabs. So we think that's a conservative and a prudent approach to forecasting those rehab rents. Then in the future, in the model, we've projected market rents at about 3.5 or 3.75% per year. That also, we believe, is supported by these third-party researchers like CoStar, the appraisal. We're seeing, like I mentioned, this year, rent increases between 5 and 10%. Depending on whether we're retaining the tenant and just renewing a lease or putting a new tenant in. So that's about 2 or 3 times above what we're projecting into the future. And with the really great demand and virtually no new supply coming to the market, we'd expect some really favorable rent growth and a lot of pricing leverage on the landlord side, at least in the near term, next 1, 2, 3 years. And so we think we can outperform on average our 3.5 or 3.75% projection. Also, I guess we're looking at the comps. We want to make sure that we're priced well among the comp set, and that the comps are also seeing these big rent increases, which they are. And so that's another data point that we rely on and makes us feel good. Well, very good. Thanks for being with us for the presentation. Appreciate you joining with us today. You're welcome to contact me or Carlin for any follow-up discussion or other information. We'll look forward to partnering with you on a successful investment in Canopy 2. This will conclude our webcast. We'll talk to you again soon. Have a great day.